Is it a new iPad or is it old? Hey folks, let the games begin. Couple of very quick announcements. I think I've returned all the DCFs now. I'm sick and tired of DCFs, but if I haven't returned yours, it's probably because you got the subject something else and you kept sending it the old subject. So if you haven't got your if you never sent it, don't expect it back, right? But if you did send it and you haven't got it back, check to make sure, send it again. I'll get it back to you. Second, I think pretty much most of you, I think, have picked up your quizzes. The stack is tiny, so I'll make sure that whatever quizzes are not picked up by this evening go into my office because I can't leave them out anymore. So that's the second. Third is I've been told that the bookstore has packet 2. Today we're going to start in packet 2. If you don't have packet 2 today, not the end of the world, but bookstore has packet 2. So today we're going to put our pricing hats on. So I'm going to do a few pricing questions before we get started. Right? The first is, I'm going to give you evidence today that most people out there prefer to use pricing, multiples and comparables, PE ratio and 15 companies. And if you ask equity research analysts why they do not like to do DCF, why they prefer to use EV to sales or EV to EBITDA PE, the answer you usually get is, hey, to do a discounted cash flow valuation, you need to make assumptions about growth and risk and cash flows, all those things you have to do in your DCF. Whereas to do pricing, you don't have to make those assumptions. Is that true? Is that a good reason to use pricing? Because that's often the most common reason given for why people like multiples and comparables, is you don't have to make assumptions about cash flows, growth, and risk. When you use 22 times earnings, or 5 times revenues, or 3 times book value, are you making assumptions about cash flows, growth, and risk? Yeah? The only thing is you're making them implicitly. You don't even know what you're making as an assumption. To me, that strikes me as a very dangerous game to play. So here's the difference. In discounted cash flow valuation, you're actually explicit about your assumptions. In multiples, you're implicit about your assumption. You know the advantage of being implicit is? If people don't know what you're assuming about growth, they can't disagree with you. It's so much easier to sell a pricing, one of the things we're going to talk about today. But it's not true that when you use pricing, you're not making assumptions. You're just making implicit assumptions. And today I'm actually going to give you a very simple technique to make those implicit assumptions explicit. So if you use PE ratios, these are the 3 variables. This is the relationship. Question? You are assuming the market. In fact, remember when we started this class, I said any time you sit down to put a number on a company, you're making assumptions about markets. In intrinsic valuation, we assume that markets make mistakes on companies and correct them over time. That's why we buy cheap stock and all. In pricing, we assume markets are correct on average, but that they misprice individual stocks. In other words, on average, chemical stocks are correctly priced, but individual chemical stocks might be mispriced. So you're making an assumption about markets being right on average. You're saying, what if I assume that markets are right on individual companies? Then you believe in efficient markets. So pricing, you are making an assumption about markets. And we'll talk about why that assumption might suit you as an investor, as a portfolio manager, because of the way you get judged and evaluated. Here's the second question. You estimate the P/E ratio for all companies, and I'm going to show you a frequency distribution. Remember for statistics you put a histogram? I'm going to show you a histogram of P/E ratios. Can that distribution ever be normal? This requires some digging up your basic statistics. Can the distribution of P/E ratios across US stocks or across global stocks be normal? What does a normal distribution require? Tails on both sides. They have to go from minus infinity to plus infinity, right? No multiple can ever be normally distributed. Why not? What's the lowest value P/E ratio can have? 0. Once you get below 0, you're done. Okay? It's not meaningful, not available. You can have a P/E ratio less than 1. You can have a price. It's an incredibly cheap stock, or something's gone crazy with the stock. But P/E ratios are floored at 0. What's the highest value P/E ratio can take? 50,000? You say, no way. I'm going to show you the distribution of P/E ratios. You're going to be shocked by the highest number. So you're saying, who cares? This is not a statistics class. I didn't pay enough attention during my statistics class. I'll make a confession. I never thought I would ever need that stuff for the rest of my life. I wish I'd paid more attention. Because you know how much of stuff we do on a day-to-day basis is built on the presumption of symmetry and normal distributions? I'll give you a simple example. How often have you heard a sales pitch? This stock is cheap because it trades at less than the average PE for the sector. It's in fact the most common sales pitch that equity research analysts use. You know what's wrong with that sales pitch? The average is a good measure of distribution if you have a symmetric distribution. But if you have an asymmetric distribution like the one I have, the average is a terrible number to focus on. Why? If all your outliers are big positive numbers, what's going to happen to your average? It's going to get pulled out. And remember in your statistics class, if you had a sensible statistics professor, and I don't know whether you did, what you were told to do when you have an asymmetric distribution, what should you be comparing? If you had to pick a number out of the distribution, the average doesn't work, what were you told to compare to? The median, the 50th percentile. How often have you heard an equity research analyst put out a pitch saying, this stock is cheap because it's trading at less than the median PE for the sector? The name of the game in pricing is statistics. And we often seem to ignore statistics in coming up with pricing rules. Finally, let's suppose you have a stock that has a PE ratio of 12 in a sector where everything else seems to be trading, or the average PE is 20. Okay, so stock has a PE of 12. Based on this comparison, would you conclude that the stock is cheap, the stock is expensive, or the stock is fairly priced? Let's start with this. In fact, you could make cases for this. If you say the stock is cheap, which is probably the most common recommendation, what are you implicitly assuming about the stock? What are you assuming? It's going to, no, in fact, you don't want to continue at 12. You won't make money by the 12 going towards the 20, right? You're implicitly assuming that your stock has the same cash flows, growth, and risk as the average stock in the market. If that is true, the stock is cheap, right? Because then mean reversion will kick in. But if the stock has lower growth or higher risk or terrible cash flows, you know what? At 12 times earnings, the stock could be expensive after I control for those differences. Or maybe after I control for the differences, I could conclude the stock is pretty much where it should be. You're saying you can find it cheap. In fact, one of the things we're going to talk about is how to control for differences, because if you can't do that, you're going to be stuck, right? You can say, I don't know whether the stock is cheap or whether it's risky. I don't know whether it's cheap or there's lower growth. We're going to talk about very simple, again, statistical techniques. What I want you to do as we go through this pricing section is remember to be pragmatic. We're no longer holding on to fundamentals. We're not talking about intrinsic value. We're talking about pricing. And the name of the game in pricing is you listen to the data. You look at the data. And if your data disagrees with the fundamentals are what leave the table, not the data. So with that set up, let me go back to the very last section of the first packet, because I don't think we quite completed it, where I talked about the pricing process and the value process. Remember that after the quiz, we talked about the value and the pricing process. I said the two processes can yield different numbers. In fact, it wasn't after the quiz. It was Wednesday. We had a full class. So the value process gives you a value. The pricing process gives you a price. And we said the two numbers can be different. In fact, the way you think about the difference between price and value tells me something about your investment philosophy. If you tell me that the value process and the pricing process yield roughly the same number most of the time or all of the time, you're a believer in efficient markets. Remember, in efficient markets, we don't claim that the price is equal to the value. We just say that the price is a good estimate of the value. So if it's wrong, it can cut in both directions. Mistakes can be made, but they can cut in both directions. So if you believe that there's really no gap, that this is just an attempt to find something which is not there, you're a believer in efficient markets. But let's say you go to Omaha, you're a value. I'm going to call you an extremist because you believe that value wins all the time. You believe there's a gap, right? You believe that you come up with a value and there's a price out there. The gap is all the market's fault. You did your job, you got the value, it's the market's fault. And what happens? You're righteous. You assume that the price will adjust to the value. So you assume that this is a given. It's not even faith, it's a belief. So if you're a value extremist, you think your job is to come up with a value. The market is this crazy market. It comes up with the price, but the price has to adjust to value. But there's a third group. I call them pricing people. And pricing people says, what's this value crap that you're talking about? Who cares about value? How do you make money when you're in a pricing game? You buy at a low price, you sell at a high price. Okay. Tomorrow I'm supposed to be on CNBC at 5 talking about I don't know what. But the reason I like that 5 o'clock slot is I'm with 5 traders. And I like being with them because they have no pretenses. They tell me to my face, this value thing that you want, waste of time. And you know what? If you're a trader, that's exactly how you think about value. You say, who cares what the value is? This is about price. So if I can buy Lyft at whatever, say whatever price is, $65 and sell it at 75, who cares that the value is 54? So I divide the world into investors and traders. When you play the investing game, you estimate value compared to the price, and then you hope and pray that the price adjusts to value. If you're a trader, you buy at a low price and sell at a high price. Is one game better than the other? No. If you can make $1 million trading with charts, and I make $1 million in a DCF, my $1 million buys exactly the same stuff as your $1 million, so why should I think of myself as a good person and you as a shallow person? The reason I say that is for whatever reason in markets, it's viewed as good to be an investor. Look at how many people claim to be Warren Buffett followers, and bad to be a trader. In fact, we don't even call them traders, right? What's a word that we use to describe people who buy and sell and buy and sell? We call them speculators. And because of that, we've created a problem. People who trade for a living can't admit they're traders. They've got to claim to be investors. It's delusional. You run into portfolio managers who claim to be value-based. And then you look at the top 10 stocks in their portfolio and they're all 10 momentum stocks. How the heck did that happen? So one of the messages I'd like to deliver is there's nothing wrong with playing the trading game. If that's the game you came to play, play the game well. But if you want to play the investing game, it's a different game. If that's the game you came to play, play that game well, but don't go back and forth across the two games. So let's take each of these games. Let's start with the trading game and look at the weakest links in each game. If you're playing the trading game, here are your 3 problems. The first is you have no anchor. You know what I mean by that? When you play the trading game, you have no fair value that you go to. It's whatever the price is whatever the price is. Which means a lot of what you do will be reactive, because you have to look at what the market does and then move with it. And finally, you are playing the crowd game, and we know crowds are fickle. If any of you read The Madness of Crowds, it's a very old book. It's a book by a guy called Charles Mackay. It's been like 200 years old. And basically in the book he describes bubbles in 19th century England. There's the South Sea bubble. So basically he describes how bubbles form. And in the 19th century England, here's how bubbles form. Is you spread rumors. You know how you spread rumors in the 1800s? You went to a pub and you whispered really loudly, acting like you were drunk. Other people heard you, and then they went and bought whatever you whispered about. You think those primitive people. Hey, what do you think CNBC is? It's today's version of the pub. So what do? You go and speak loudly. So the game hasn't changed that much. We just have more sophisticated ways of spreading rumors. The Madness of Crowds basically talks about how fickle crowds can be. And when you play the pricing game, you could be there today, gone tomorrow. The momentum could be in your direction, gone in the other direction. So when you're a trader, those are the things you fight. Doesn't mean you can't be a successful trader, but those are the things you got to overcome to succeed. If you're an investor, though, what are your two biggest worries? The first is there a gap, right? You think there's a gap based on your value. You tell me the stock is undervalued, but why are you not sure? Because the value that you came up with was an estimate, right? You could be wrong about that number. So you think, I think there's a gap, but I don't know there's a gap. You know what the second thing you worry about is? Even if there's a gap, will it close? So each of these you try to reduce your exposure. Let's start with whether you're worried about the gap existing. The first measure that some investors use is called the margin of safety. Heard of the margin of safety? You know what it is? It's actually a very widely used approach in value investing. Do you know what that is? What's the margin of safety? Yeah, so it's been around a long time. In fact, there's a book by a guy called Seth Klarman that's now out of print, where you've got to pay $2,500 for the book to buy the book. It's called The Margin of Safety. It's very simply, here's how the margin of safety works. If you have a 25% margin of safety, you will buy stocks only if the price is more than 25% below the value. Okay? You think this is good, I'll make it 40% below the value. In fact, many value investors say, look, my margin of safety is 85%. What do you have in your portfolio? Nothing. And that's one of my concerns with margin of safety is there's no glory in margin of safety if nothing comes through. This is not a risk measure. It's a way in which you protect yourself, but you need to value the company first. So is the margin of safety good? I would love to buy stocks which are more than 40% undervalued, but beggars can't be choosers. If I find only one stock that's more than 40% undervalued and I still have money to invest, guess what? I'm going to keep looking. But the margin of safety is one approach that people use saying, look, I'm uncertain, so I want the gap to be at least this much, and I understand. The second is, if people are uncertain about the gap, they think collecting more information is going to make them feel better about it. Do you think it ever works? Try this in your company. You have a gap. You're uncertain. You're saying, I don't know whether to buy or sell now. It just looks very... You go collect more information. I guarantee you, 3 weeks from now, you'll be even more uncertain. The third is you ask what if questions. What if this, what if that, what if this and that? If you think that's going to make you feel more certain, then you're a very strange human being. It just makes me feel more uncertain. My advice is, if you feel uncertain, look it in the face. What are you talking about? Remember those Monte Carlo simulations? You know why I do those simulations? To remind me that my estimate of value is wrong. It's very strange. By looking at how uncertain I am, I get to feel a little more comfortable about the fact that there's a gap. Those percentiles, I mean, it reminds me that investing is never a certainty. It's a game of odds. And if I can shift the odds in my favor, then I'm going to come out ahead. Now, in terms of what you can do about the gap closing, there are two ways you can think about the gap. The first is what I do on most of my investments. It's what I call my karmic view. I did my homework. I've done my valuation. This is all I control. There's a price out there which I don't control. Maybe the price will move to the value, maybe it won't. It's out of my control. Nothing I do is going to make the price move to the value. It's a karmic view. You do your homework, you do your DCF valuation, there's a price out there, you buy, and then you let it go. Sometimes you win, sometimes you lose. You hope you win more often than you lose. The second is, and this would be nice if you can pull it off, is you buy something because the price is lower than the value, and then you act as a catalyst to make the price move to the value. This is the advantage that a Carl Icahn or a Bill Ackman has over you and I, because right after they take a position on a stock, what do? They get on CNBC. They announce the word. They get a Wall Street Journal article. What are they trying to do? They're now trying to get people. There's nothing unethical. They're doing, if it's front running, they're doing it completely openly. They're saying, I have a position. I am influential enough to make the price move to the value. Now, tomorrow on CNBC, I'm going to throw out a few names. It doesn't seem to work for me like it does for Bill Ackman. A few stocks in my portfolio really want up at least 10%. I'll give it my best shot. Nothing is going to happen to the stocks. So for me, it doesn't, it's not like it can move prices. So I look for my own catalyst. I look for things in undervalued companies that might lead to a reassessment of the company. Like what? I actually look for undervalued companies with really old CEOs. I know this is a morbid thought, but really old CEOs tend to kick the bucket. And when they kick the bucket, there's a reassessment of the company. For better or worse, when new management comes in, I know this sounds absurd. The age of the CEO, I think, is on Capital IQ. So throw it in as a screen. I want only undervalued companies with CEOs over the age of 80. I look for, in Capital IQ, you can get corporate governance scores, which tells you how. I prefer undervalued companies where things can change rather than companies where you have two classes of shares. So when I think about the gap closing, I'm looking for some mechanism that will lead people to take another look at the company. And if it makes my odds better, then I'll take them. So there are no sure games here. If you want to be a trader, you got your own set of uncertainties. As an investor, I have mine. So I'll use a company where I've played this game now for 10 years. Okay? The company that I confessed up front at the start of the class that I love the company too much, but I tried to value the company. And essentially what you have here is the stock price over the last 10 years. But I've actually valued it every 3 months, but I've showed you my September valuations every year for the last 8 years. So go back to September of 2011. The price per share was $54.47. The value per share that I got was $69.30. I bought the stock. 1 year later, the price per share jumped to 95. My value per share went up as well. So this notion that intrinsic value doesn't change is absurd because information comes in, but the stock became mildly overvalued. I sold the stock. So basically you can see you're essentially with intrinsic value playing the market. This was one of my happy endings and might be pure luck, but in September of 2018, which was the last September valuation, the price per share was $225, the value was $201. That's when I sold short. And then one of the advantages of using simulations, you can build in that automatic buy. I covered, and of course at 175 it got back to being cheap again. Now it's a pain in the neck though from a tax perspective, and actually the alternative is a lot worse, which is you always have losses and you never have to. I'd rather make money and pay taxes than lose money and say, oh God, I have no tax worries at all. I'm bankrupt, right? So if you're going to have a problem, it's a good problem to have. Is I did buy at 175 because the stock did drop to 175, and you've been tracking Apple, it's back up to almost 200. So it's time for me to leave soon. But I'll be back. That's basically how I think about stocks, is I've sold now, but this is not permanent. It's like getting remarried to the same person over and over and over again. But at least each time you get married, it seems to end well or end badly, depending on how you think about endings. But my point is, don't think about, because sometimes people say if you're an investor, it has to be a long time horizon. And here's how I think about it. I'm willing to have a long time horizon, but I don't have to have one. So if everything goes my way in 3 or 6 months, I will sell in 3 or 6 months. I'm not going to sit there saying time horizon has to be 10 years for you to be an investor. So I'm going to close with a picture. One from one of my favorite movies. Recognize the movie? Come on. It's the most famous movies of all time, The Wizard of Oz. You guys have seen The Wizard of Oz? Come on. Who hasn't seen The Wizard of Oz? Okay. You have to see the movie. I'll compress the movie for you. It's about a girl called Dorothy who lives in Kansas. And I think a tornado sucks her up. Don't look at me like that. I don't write these movie scripts. This is how it was written. Sucks her up. And she's swirled through the air and dropped into Oz, and she lands on top of the wicked witch. I forget, east, west, I keep getting them mixed. One of the witches, and kills the witch. Facing homicide charge. This is how the movie starts. It's very traumatic. The first 5 minutes. If you have kids, go after the first 5 minutes. The first 5 minutes, she lands on the witch, kills the witch. And she wants to get back to Kansas. Why? I don't know. She should have stayed in Oz, but I guess. So she turns to this munchkin by the side of the road and she says, I need to get back to Kansas. What do I need to do? And the munchkin says, you got to see the Wizard of Oz. He can do anything. It says, how do I get to the Wizard of Oz? And it says, follow the yellow brick road. So for the rest of the movie, you follow Dorothy in the yellow brick road. She hops, she skips, she never walks. Watch the movie. She never walks ever. And while she's hopping and skipping down the road, she collects a motley crew. A lion that needs courage. A Tin Man, a Scarecrow. They all need something. They're all told, go see the Wizard of Oz. He has the answer to your problems. 2.5 hours later. It's a really long movie. they make it into the chambers of the wizard. So each of them states what they want. Dorothy says, I want to go to Kansas. The lion says, I want courage. And the wizard says, I can't do anything today. Come back tomorrow. It's like a government office. They say, we've been hopping and skipping to come to this for 2.5 hours. We can't come back tomorrow. At that stage, the curtain falls. And they discover there's no Wizard of Oz. There's some small guy back there pulling strings with a loud, with a deep voice. You think, what's this got to do with valuation? If you watch the movie, though, every one of them got what they wanted on the journey. Dorothy picked up these red shoes, and she clicks the shoes. She's back in Kansas. The lion fought off some bad guys, got the courage. So each of them got what they wanted on the journey. In valuation, people think there's the equivalent of the Wizard of Oz. Usually it's Google search that you use as the Wizard of Oz. Should I use an effective tax rate or a marginal tax rate? Let's Google it up. Google search has been deadly for valuation because nobody wants to reason their way to an answer anymore. They're convinced that the answer is out there. Usually it's the wrong answer, but it's up there, leading search item. If you want to find the answers to questions in valuation, you will find it in the process of doing valuation on the journey. There is no destination. There is nobody out there who has the answer because in a sense you've got to reason your way to an answer. I mean, we're done with intrinsic valuation, but we're not quite done because as you do intrinsic valuation, there will be questions you're going to run into and say, I wish I could go ask somebody. Don't. Reason your way because you have the tools now to come up with the answer you need. Should you use an effective or a marginal tax rate? How do we decide? If you have cost of debt, we said, go with a marginal tax rate. Why? Because interest saves you tax in the margin. If you're looking at all of your income, we can go with the effective tax rate because you're looking at the tax rate. But there we added the caveat. You can't keep doing this. Why? Because you can't keep deferring taxes forever. That's not a rigid rule. It's based upon reasoning. What am I trying to do? So always go back to basics because the answer is going to be there. So now let's start on packet 2. What's going on here? Okay. For whatever reason, it doesn't want to show you the front page, but that's okay. So let's start on pricing. Early in this class, I told you much of what passes for valuation out there is really pricing. When people claim to have put a value on something or claim to do a job in valuation, their job is really a pricing job. Let me back that up. If you look at the essence of pricing, here's what you're trying to do in pricing. You're not trying to estimate the value of something based on its cash flows, growth, and risk. You're looking to see what other people pay for similar assets. So if you break down pricing, there are 3 parts to pricing. The first is you need to find other assets just like yours. Odds are you might not find something exactly like yours. So if you're looking at a Yankee ticket, you're looking for other tickets in the section to see what they sell for. If you're looking at a house, you're looking for other houses like yours. If you're looking for a stock, you're looking for other stock like yours. So that's the first step. Second, you try to compare prices across these different assets. You might realize that the prices are not comparable. With real estate, why might prices not be comparable? You have a 3-story building next to a 30-story building, the price of the building. So there we standardize price by dividing price per square foot. Right? Small building. If with equity or stocks, we divide price by earnings. So a multiple is just a standardized price. So we find comparables, we standardize the price, and then we compare across the companies. And we're careful, we realize there are differences. The company we're looking at is riskier or has higher growth, we try to control for differences. The essence of pricing is those 3 steps: coming up with the comparables, standardizing the price, controlling for differences. So early on I told you that most of what you're going to run into is pricing. Let me back up that statement. About 20 years ago, I collected 550 equity research reports from around the world. I must confess I didn't read most of them. I collected them because I wanted to chronicle how equity research analysts approach putting a number on a company. How do they come up with that target price? Out of the 550 equity research reports, 45 were discounted cash flow valuations, 45, less than 10%. 450 were pricing, multiple and comparables. You think 450 and 45 is only 495. What about the other 55? Kind of scary. Kind of search for self. I don't know what they were doing, but no, I kind of abandoned them. Among the ones I could categorize, 10 to 1, pricings outnumbered discounted cash flow valuations. In equity research, pricing seems to be the dominant approach to putting a number on a company. So when you go to sell-side equity research, don't be surprised to see multiples and comparables. It's the name of the game. So I said, maybe it's different in corporate finance. I was able to get my hands on about 100 acquisition valuations done by banks. You know how difficult it is to get your hands on those? Because once they do them, they lock them to make sure nobody can ever see the stupid forecasts they made and compare them to the actual numbers. But I have my sources. I called on them and I collected about 100 acquisition valuations. There on the surface, it looked like there were about 50-50. 50% were DCFs, 50% EV to EBITDA, price earnings again. But then I took a closer look at the 50 that claimed to be DCFs and concluded that most of them were pricings in drag. What am I talking about? What's the biggest number in a DCF? The terminal value. And the terminal value is based on 8 times EBITDA or 3 times. So even the DCFs were really pricing. So even in acquisitions, it looks like it's pricing. Almost every rule that you see out there, rule of thumb in investing, is based on a multiple, right? Price to book ratio less than 1 is cheap. PEG ratio less than 1 is cheap. PE less than 8 is cheap. Nobody uses DCF rules of thumb. So clearly, pricing dominates valuation out there. And when I first found this, I was a little surprised, and here's why. At the end of this class, I'm going to do an exit interview. I'm going to ask you a question, because by the end of this class, you'd have done a DCF valuation on your stock. There's more coming on your project, so I'm going to describe with them. You're going to do a pricing of your stock, which is a lot less involved in your DCF, and then you're going to make a recommendation of whether to buy or sell the stock. So at the end of the class, I'm going to ask you, and this is a question I asked you, I think, right at the start of the class. Now that you've tried your hand at DCF and pricing, which one do you like more? And through the 32 years I've taught this class, and the 54 semesters that I've taught this class, the breakdown has been roughly the same. Maybe this class will surprise me. It's been about 70, 20, and 10. 70% at the end of the class said that they like this DCF stuff. It's really much, reflecting, I guess, my biases. About 20% said this pricing stuff was a lot nicer. I like it more to use a multiple and comparables. And the remaining 10% become believers in efficient markets after they've tried to put a number on a company. Said, I thought this is a lot more difficult than it looks. Maybe the market's not that stupid. But 7-2, when people leave this classroom, they go out as believers in intrinsic value. I'll wager, if I track you guys down 5 years from now, at whatever job you're in, if it involves putting a number on a company, that the numbers get flipped. That by the time you spend 5 years on a desk, even true believers, when they start an intrinsic valuation, start to use multiples and comparables. So I started thinking about, why does that happen? What happens between the time people leave this classroom and you get on your desk that makes people go from believers in valuation pricing? And 3 possible answers came to me, and you can add to this list. The first came to me while I was watching a Seinfeld episode. This episode, one of Jerry's girlfriends accuses him of being crazy. And he says, if you think I'm crazy, you should see the guy who lives across the hall from me. Talking, of course, about Kramer. And relative to Kramer, who's crazy, right? And in a sense, it cuts to the heart of pricing. In pricing, you get to pick the comparables. You can tell me any story you want. You have a cholesterol of 300, not too bad. Relative to people who've died of heart attacks in the last week, you look really good. All I need to do is pick the right comparison, and I can sell you anything, buy anything from you. The essence of pricing is it's malleable. You can make a company be cheap or expensive depending on what you compare it to. We forget how much a valuation is selling. It's easier to sell a pricing than to sell a discounted cash flow valuation. I know whether you remember, but last session I valued Amgen. I valued it at $74. The stock was at 55. May 1st of 2007. May 2nd, let's assume that I call you and pitch Amgen to you. And I say, look, I think Amgen's cheap. Let me explain why. It has a 60% reinvestment rate and a 16% return on capital. I multiplied the two. I came up with a 9.6% growth rate. I used to be 801. Who has the time for this in the morning? You hang up the phone. We try a different pitch on you. Amgen looks cheap. It's trading at 12 times earnings. All the other pharmaceutical companies trade at 16 times earnings. It's not the most sophisticated pitch, but it gets a hook in. It's easier to sell a pricing than a valuation. It's easier to defend a pricing than a valuation. Think of why. When you did a valuation, all your insights were out there for people to pick apart. They don't like your beta, your cost of capital, your growth rate, your length of growth. Everything is out there. Whereas if I tell you Amgen looks cheap, it's trading at 6 times EBITDA, because that's what the rest of the sector is trading at. Think of how small the target is. You don't like 6 times EBITDA, take it up with the market. With pricing, that's what I'm saying. It's not my fault. You don't like to pay 30 times revenues for Lyft. You should see what Uber is going to go for. It's not my fault. I'm just the messenger here. Take it or leave it. It's much easier to defend the pricing. And finally, and this is, I think, something we underestimate. I believe that in the long term, you're more likely to be right with valuation than with pricing, with the DCF. But it's not 100%. So it's maybe 65% right with DCF and 50% right with pricing. But here's the catch. When you find something to be cheap with the DCF, when you're wrong, you're far more likely to be wrong alone. You're saying, so what? You know what happens to people who are wrong alone? They get fired. If you're wrong with a multiple, you'll always have lots of company. You bought the stock because everybody else was piling in. The stock reversed. You say, not my fault. I was just doing what everybody else was doing. Don't underestimate the survival impulse. Portfolio managers who use multiples are more likely to hold on to their jobs and survive than portfolio managers who use discounted cash flow valuation. It's a reality that we have to accept. 25 years ago when I used to teach this class, I used to try to talk people out of pricing. I don't anymore, because many of your jobs are going to require pricing. You got DCF tools, have fun with them, because this might be the last time you use them. Because once you're in a desk, you might never see a DCF again, even though on the face of it, it's a valuation job. You're going to be doing a bunch of pricing. So what we're going to talk about is doing pricing better. Because the reality is your job might require pricing. Might as well talk about how to do it right. Because there is a market imperative that many of you are going to face. There's a reason why pricing wins. If you're a portfolio manager, if you work for Fidelity, you run an equity mutual fund, what do you have to be? You have to be invest in equities pretty much all of the time. You don't have the luxury of saying, I think everything is overpriced or overvalued. I'm not going to buy anything. It's not a choice. And when you get judged, what do you get judged against? You don't get judged against absolutes. You get judged against other mutual fund managers who adopt similar strategies. Everything is relative. We live in a pricing world. Everything gets judged on a relative basis. We shouldn't be surprised that pricing ends up being the instrument that people use. So let's start to talk about mechanics. I said to use pricing, you got to standardize prices. Why? Because you cannot compare price per share across stocks. Why is that? If I just define price per share as expensive or cheap, what's the most expensive stock in the US? Berkshire Hathaway. It's got 6 digits in its name. What's the cheapest stock? I think MoviePass is now 0.000006 cents per share. So if you define cheap, that's a really cheap stock, right? You can see the absurdity of it. The price is an arbitrary number. I do a 2-for-1 stock split, I can have the price. So we standardize prices. A multiple is just a standardized price. So let's break down a multiple. In the numerator, you will always have some measure of market value. It can be market capitalization, price per share times the number of shares. It's the market value of equity. It can be market value of equity plus market value of debt, though you might cheat and use book value of debt, which is the market value of the firm. Or you can take market value of equity plus debt minus cash, which is called enterprise value. They're all measures of what the market thinks about your company. So the numerator is always a market number. It's in the denominator that you get the real game playing. I could divide the market value you got by your revenues. Why would I use revenues? Desperation drives me up the income statement. Everything else is negative. I'm going to go with revenues. And if you have a pre-revenue company, I'm really, really desperate. So I divide by something that might give you revenues. Like how many bike apps do you have? How many downloads do you get? How many subscribers you have? You need a positive number in the denominator, and you're going to go look for it no matter what. So you could divide by revenues or revenue drivers. You could divide by earnings. The earnings can be equity earnings, which is net income, or it can be operating income, but it's a measure of earnings. You can divide by cash flows, which for equity can be equity income plus depreciation, net income plus depreciation, or if you're looking at the entire firm, can be operating income plus, which is EBITDA. You could divide by book value, which is after all what the accountant thinks the company is worth. You can divide by book value of equity, or you can divide by book value of equity plus book value of debt, which is the book value of the firm, or you can take book value of equity plus book value of debt minus cash, which is invested capital, which is what we've used. So in the denominator you have a scaling variable, in the numerator you have a market cap. I'm going to take you through a 4-step process for assessing or breaking down multiples, deconstructing multiples. And if you can be religious about following this process, you can be a good pricer. Okay? The first step in the process, I'm going to start off today by defining a multiple and laying out a couple of propositions about multiples that it's worth remembering whenever you use a multiple. Okay? So I'm going to start by, so if you it might be a little insulting for you because I know what a PE ratio is. You're going to be surprised at how many variations there are on a PE ratio or EV to EBITDA, so we're going to dig a little deeper. We're going to define the multiple. Second step in the process is I'm going to describe the multiple. Sounds fancy, but I'm going to play some money ball. I've never understood why we have rules of thumb when we have the actual data in front of us. Why should we decide 6 times EBITDA is cheap when I can provide you with the entire distribution? So I'm going to put up the distribution and use it to extract some statistical information about how multiples work. So define, describe. Third step, I'm going to analyze the multiple. I'm going to argue that embedded in every multiple are all the assumptions we have in DCF, and I'm going to be explicit about it and give you a way of extracting what those variables are. Key step because it tells you what you need to control for with a multiple. And only then am I going to apply the multiple. And I'm going to define comparable, both narrowly and broadly, and I'm going to talk about how different the answers can be. Define, describe, analyze, apply. You know what the problem with pricing is? People are in a hurry to get to the apply stage. You pick a multiple, pick comparables, they're off to the races. You have to have the patience to go through the steps. So let's start with the first step. When I look at a multiple, there are 2 questions to ask. Is this multiple consistently defined? Is it uniformly estimated? Let me take the first definition, the first question. Is it consistently defined? Remember I showed you the picture of a multiple. There's a numerator and a denominator. Here's the simple consistency rule. If your numerator is an equity value, your denominator has to be an equity value as well. If your numerator is a firm or an enterprise value, your denominator has to be a firm or an enterprise value as well. You're saying, what the hell are you talking about? Let me throw a couple of multiples at you, and you tell me whether they're consistently defined. Let's take the PE ratio. What's in the numerator? Equity value, firm value, or enterprise value with PE ratio? Equity value. And earnings per share is? Equity earnings. Thank God for small blessings. The most widely used multiple in the world is okay. Numerator, no. So PE ratio is an equity number divided by an equity number. How about EV to EBITDA? Numerator is the market value of the operating assets of the company, roughly speaking. And EBITDA is a rough measure of operating cash flow from the company. EV to EBITDA passes the test. What about price to EBITDA? The analyst who invented this multiple should be tarred, feathered, and driven out of the fraternity. It's a horrifically bad multiple. In fact, out of the 550 equity research reports I was looking at 20 years ago, 7 used price to EBITDA. One happened to be an old student of mine. So I decided to give him a call. And he gets on, he says, who is this? I said, remember that valuation class you took a few years ago? He said, vaguely. I said, it shows. I said, what the heck are you doing? Dividing price by EBITDA, it's not consistent. He said, no, I'm being consistent. I said, what are you talking about? He said, I use price to EBITDA for all 15 companies in my sector. I said, that's a very strange definition of consistency. I said, have you been noticing that companies with a lot of debt keep looking cheap to you? He said, yes, I've been noticing that. I said, have you ever stopped and thought about why that might be happening? Do you see why this is going to happen? What's in your numerator? Market capitalization, right? In your denominator, you have EBITDA. Let's say you do a buyback, you borrow money and do a buyback, which companies do all the time. Your market cap is going to shrink because when you do a buyback, you have fewer shares outstanding. But your EBITDA is before interest, taxes, it's like before the cows come home. Your EBITDA will still be the EBITDA. The more highly levered a company gets, the cheaper it's going to look. It's not getting cheaper, but it's going to look cheaper on a price to EBITDA basis. Before you feel too superior, if you've ever used a price to sales ratio, and people do this all the time, you've been guilty of the same sin. You know why you got away with it? Because the kinds of companies we use it tend to be technology companies with no debt, or retail companies, you assume the debt is the same for all companies. But price to sales, price to EBITDA, both fail the test. Is it consistently defined? I'm going to do sub-tests with PE ratios, and you're going to see how elaborate this process can get, because if you mismatch your numerator and your denominator, things are going to blow up on you. Is it uniformly estimated? Why do I care about that? Because what am I doing? I'm comparing PE ratios across 15 companies. I'm hoping and praying that you compute earnings per share the same way for all 15. We used to think in the US, because we had the same accounting standards for all companies, that the earnings were all consistently defined. But we discovered in the last 20 years that you can have the same accounting standards and different degrees of fidelity to those standards. Conservative companies will always look expensive to you, and aggressive companies will look cheap if you don't control for those differences. Is it consistently defined? Is it uniformly estimated? Let's try this. Let's start with the most widely used multiple in the world, the PE ratio. I remember about 35 years ago, long time ago, I subscribed to Barron's. You know why I subscribed? Because they said I would get a calculator that would compute PE ratios. This is days before Wi-Fi. I said, this is neat. So I subscribed, and they sent me this cheap-looking $1 calculator with instructions on how to compute PE. You know what the instructions were? Enter price, hit slash, enter earnings, hit equal. I got exactly what I deserved, because PE ratio is price per share divided by earnings per share. I would not have subscribed if I'd known that's what I was getting. But that is, even everybody knows what the PE ratio is, right? Even Anna Kournikova seemed to know what the PE ratio was. You remember who Anna Kournikova was? Probably before your time. She masqueraded as a tennis player. She was a Russian who masqueraded as a tennis player for like a decade. Won nothing, but was in every commercial you could think of. In fact, Charles Schwab made a commercial with Anna Kournikova in 2000. You can still find it on online. Go do a Google search, Anna Kournikova Schwab commercial. And in the Schwab commercial, she's playing somebody. Must have been an actress. She was actually winning. So in tennis, you got to switch sides every 2 games. You're switching in the middle of a tennis match. I don't know why this would come up. Anna turns to the actress and says, price-earnings ratio is price divided by earnings per share. And then she started saying something about preferred dividends that went completely over my head. I remember turning off the TV and canceling my Schwab account right away. And then asking, does Anna Kournikova really know what the PE ratio is? The price is usually the current price per share. Unless you've got one of those technical analysts gone crazy. Ones I'm talking about who love to use moving averages for everything. To which my response is, have you ever tried buying a stock at a moving average price? It's really tough to do. Numerator is usually a current price. In the denominator is where you get the real differences. I can divide by earnings per share in the most recent fiscal year, which for many of your companies might still be 2017, which is current PE. I can divide by earnings per share in the last 4 quarters, which is trailing PE. I can divide by earnings per share in the next 4 quarters, which is forward PE. Or I can divide by earnings per share in the year 2028, which is really forward PE. You think, why would I do that? Because again, desperation drives you there. You're the biotechnology analyst. Every company in your sector is losing money. The only tool you have is PE ratios. You're stuck, right? So what do? You project the earnings out 10 years, and my company looks cheap. It's trading at 6 times 2028 earnings. And while you're saying, what the heck does that even mean? You get sold the stock and you move on. I can divide by earnings per share before extraordinary items, after extraordinary items. You give me any widely followed stock, I can write 30 to 35 numbers that are all technically PE ratios today, depending on how I define earnings. For Cisco, a couple of weeks ago I sat down and estimated. I came up with numbers ranging from 13 to 32, depending on how I define earnings per share. You're saying, so what? Remember we talked about bias? We all have agendas. Let's say on CNBC tomorrow, I want to convince the world that Cisco is cheap. Which of these PE ratios am I going to latch on to and talk about? I'm going to use 13 times earnings because it makes the company look cheap. If I want to convince you Cisco is expensive, notice bullish analysts always use forward numbers. Why? Because it makes their PE ratios look lower, the EV to EBITDA look lower, because the more forward you get, the lower the number looks. So PE ratios are consistent. In fact, if I'd made that Cornucova commercial, I'd have made the actress turn to her and ask, forward earnings or trailing earnings, Anna? Then we would have found out whether Anna Cornucova really knows what the PE ratio is. But the PE ratio is fundamentally consistent. But let's dig a little deeper. When you compute PE ratios for stocks, what you do is you take the price per share and divide by earnings per share. But there are so many different variants in earnings per share. So I want you to think about doing pricing in a sector where there are big differences across stocks in terms of how many options they have outstanding. So I want to come up with a measure of PE ratio that's not going to be skewed for the wrong reasons. So as I go through each one, I want to think about the consequences. So here are my choices when it comes to how I compute PE ratios. I can divide price by primary earnings per share, which is based on actual share count. If I do that, what's going to happen? Any stock that has lots of options outstanding is going to end up with a low PE or a high PE. It's going to end up with a really low PE because the price gets pushed down. But remember, when you have options outstanding, this is like the reverse of the quiz problem. Basically, with the options outstanding, the price gets lowered. And if I don't, so I'm going to end up with a bias. If I divide price by fully diluted earnings per share, I get a different problem. In the money options, out of the money options, all get thrown in. I end up with this. Price by partially diluted, different kind. You're saying, well, if everything has a problem, then what should I do? I've stopped computing PE ratios using per share numbers. It's a recipe for disaster. You're saying, how else do I compute PE ratios? Take market cap and divide by net income. Don't go per share numbers because in general per share numbers have, with restricted stock units, I don't know. So when an analyst says the earnings per share for lift is, I have no idea whether they're using actual numbers and restricted stock units. This way you can work with aggregate numbers, and the reason we're doing it again is to stop the bias that creeps in no matter how you define the earnings per share. Let's talk about another multiple. 30-something years ago when I first started investing, almost everything was PE or price to book based. Once in a while you might have an analyst who used EV to EBITDA multiples. Today you walk into any equity research department anywhere on Wall Street, you look at the equity research reports, half of them are based on EV to EBITDA. And EV to EBITDA is market value of equity plus debt. Market value of debt, where people cheat and use book debt, right, because it's too much work, minus cash. And in the denominator you have earnings before interest, taxes, depreciation, amortization. I have no problem with people using this multiple. But whenever I run into an analyst using this multiple, I ask him a question or her a question. I almost never get the right answer. So I'm going to throw the question at you. If you look at the numerator, I have equity plus debt minus cash. Why do I net cash out of the numerator when I do this multiple? Want to try? Why do I net cash out? I buy everything, so why don't I net everything else, right? I could use the cash, but should I be netting out all liquid assets then? Because I could sell those and use them as well. If the rationale is I can use it to pay for some of my acquisition, maybe I shouldn't just stop with cash. I should be going with any liquid asset, and I don't. I just stop with cash. Yeah.
Would it already be accounted for in market value?
Well, lots of things are, but in a sense, that, so if I say it's counted for, why don't I subtract out brand name? In fact, if I go down that road and say anything that's counted for I'm going to take out, I'm going to be in huge amounts of trouble, right? Yeah.
You benchmark EV to EBITDA with some form of like return on operating assets, and the cash is not.
I think you're on the right track. You're just making it a little more complicated than it has to be. Look at the denominator. The answer is right there. What's in my denominator? Earnings before interest, taxes, depreciation, amortization. You know why we net cash out? Because the income from cash is not part of my denominator. It's as simple as that. And once you open the door, you've got to walk all the way in. In addition to netting cash out, if I really want to come up with an enterprise value to EBITDA, remember Tata Motors? I did the valuation of the company. A big chunk of the value came from what? Cross holdings in other companies. And why did we have to add those cross holdings? Because income from minority holdings don't show up as part of your operating income. Guess what? If I compute the EV to EBITDA for a company with minority holdings in other companies, In addition to netting out cash, I should be netting out the market value of those holdings. So if you thought you could run away from a cross-holding problem by using pricing, guess what? It's going to chase you down and jump on your back. And if I have a majority holding, I have a different problem. Let's see what it is. Let's say I own 60% of another company. I'm trying to compute the EV to EBITDA. But I do the market value of equity. What's in my market value of equity? Markets are not stupid. They don't consolidate. They reflect the 60% that you hold. So your market value of equity will include only the 60%. Everything else comes out of consolidated statements. So my debt, cash, and EBITDA will reflect 100% of the subsidiary. I have a mismatch problem. My equity reflects only 60%. Everything else is 100%. So you know what analysts do to kind of fix this in a half-assed way? Is there some measure of the 40% that doesn't belong to you on the balance sheet? It's called minority interest, right? So you know what they do? They add the minority. It's a hopelessly half-assed way of doing this because that minority interest is a book value. But they say, oh, you know what? I've cleaned up the problem. I've added the 40%. But it's consistency. Next time you look at a multiple for a complicated company, you start cleaning up. You realize how much work there is to do to come up with a number you can use. One quiz from, the third quiz will be all about pricing. One quiz, actually, there was one problem where people asked to compute the EV to EBITDA. They came to me and said, you don't want us to use it? I said, just compute it. It's simple as that. And I threw in cross-holdings, and I threw in cash, and I threw a minority and a majority holding. Hey, that cross-holding problem in your DCF quiz is going to come back in your pricing quiz as a problem when you compute EV. And finally, in the aftermath of the 2008 crisis, people started asking questions about how do we know whether housing is in a bubble? And one of the measures that people started to come up with to figure out whether housing is in a bubble is they took the price of a house and divided by the rental income you could make on the house. It's a ratio. When that number is really high, it means the prices have lost connection to fundamentals. So let's assume you are an investor and you're trying to decide whether to put your money in housing or real estate collectively or to put your money in stocks. You computed this housing price to rental income ratio for your company. So think about that. That's the ratio you have for housing, for housing. What would the equivalent rate, because you have to compare apples to apples, what would the equivalent ratio be for stocks? And I'll give you the choices. You can use price to earnings, EV to sales, EV to EBITDA, or EV to EBIT. So I've computed the housing price to rental income ratio as 8 across houses. What would be the number I would compute for stocks to make a comparison to decide what's cheaper? Yeah. First, tell me why I can't use a price multiple. What's wrong with the pricing multiple? Because I'm looking at the total price of the house, right, which is like enterprise value, and look at the equity portion. So all equity multiples are off the table. You said EV to? Sales. Is the rental income closer to sales or is it closer to? It's actually closer to EBITDA. Sales is a tough concept. I think it's closer to EBITDA because from that rental income you can claim the depreciation and other expenses. It's actually even a little fuzzier than EBITDA because there might be other maintenance expenses that have to come out of the rental income. But the number that's probably closest here is EV to EBITDA. Would that make cheap? So if stocks trade at 6 times EBITDA and housing is trading at 8 times rental income, is stocks cheaper? Well, if you believe in pricing, that's exactly where you'd go. But the way you make that comparison is by trying to make sure that you're comparing apples to apples. You can already see that pricing requires a little finesse about what exactly you're comparing. You can never compare a PE to an EV to EBITDA. That's an impossible comparison. You have to make sure you're comparing apples to oranges. Or sorry, apples to apples, oranges to oranges. So that's the first step, is definition. Any questions on the definitional test? Is it consistently defined? Is it uniformly estimated? Let's move to the second phase, and this is pure Moneyball. When I look at a multiple, I want to get a sense of what the data tells me about what's high, what's low, what's average. I need to be able to look at the data fully. As opposed to what? As opposed to a single number. An average PE it seems to me incredibly lazy and sloppy in today's day and age to not look at all of the data. 30 years ago, you could have an excuse, right? It's too much work to get all the data. I can't do it. Today, you have access to Capital IQ. You can download 43,000 companies in 15 minutes, whatever multiple you want, and look at all the data you want. And as you look at the data as I present it, I want you to get a sense of, because what you're going to see across these multiples is a sense of the statistical properties of these multiples that will play into what kind of decision rules you want to come up with. So I'm going to show you first how asymmetric these distributions are. And along the way, I'm also going to talk about the biases we create when we use a multiple because we lose some companies with that multiple. Like what? When the earnings are negative, you can't compute PE ratio. When your book value is negative, you can't compare price to book. So we're going to talk about how that can bias your results. So let me start with a distribution that I put up at the start of every year, where I take all US stocks and I compute the trailing PE, the current PE, and the forward PE for every single stock. Then I put up a histogram. Histogram, no rocket science. I just count the number of stocks with PE ratios less than 4, 4 to 8, etc. That is the distribution for US stock PE ratios at the start of 2019. Remember we said that, no, it should be, I'm sorry, I should have updated this, 2018. 2019 looks the same, it's the same kind of distribution. Remember I said distributions of PE ratios can never be symmetric. You can see that here, right? Floored at 0. And in fact, I've artificially cut off the tail by putting everything over 100 into that last number because otherwise the graph looks just weird. Here's how it's going to play out. I actually computed the descriptive statistics on each of these numbers. So basically, if you look across, there were 7,247 companies for which I had PE, that I had in my sample. I computed the current PE, the trailing PE, and the forward PE. And if I look at the average PE across all stocks at the start of 2018, that average was 71.28. That sounds incredibly high, that an average US stock trades. But before you freak out, that's the average. The median PE was 23, a high number, but not as high. In fact, in 2019, the median's down to 19, or 18 even, but the average is still up there, 70 or 75. See, why is the average so high? In 2018, the highest PE stock had a PE of 21,560. This year, it's 49,800. You think that must be one highly priced stock. It's trading at like $6 per share, but the earnings per share are a fraction of a cent. That's what asymmetry does. It pulls the average out. In fact, here's an interesting number. See this 2,955 below the 7,247? I started with 7,247 companies, but by the time I computed PE ratios, I'd lost almost 4,300 companies. Why? Because the earnings per share were negative. I lost 2/3 of my sample with negative earnings. You see, you still have a lot of stocks in your sample. Could I be creating some bias in my results because I'm throwing out? Absolutely. In fact, what kinds of companies have negative earnings? They'll tend to be young, risky. In other words, I'm taking out a subset of the market that might be affecting my results. Bias. Let's keep going. As I go from current PE to trailing PE to forward PE, and especially as I go from current to trailing to forward PE, notice that I lose another 500 companies. 2,958 goes to 2,448. How come? Because I need forward earnings, right? There's no way I'm sitting there projecting earnings for 7,000. So guess what I look for? I look for analyst projected earnings, and if there is no analyst projected earnings, I say I can't do it. I've lost 500 companies which are not followed by analysts. And what kinds of companies will they be? They'll tend to be really small companies that are below the radar. We create bias in the most subtle ways in the multiple we actually pick. Anytime you use a forward earnings number, you're already losing a chunk of the population. Not a random chunk, but a subset that is different from the rest of the market. So when you look at multiples and you look at the distribution, you can already see this play out. Until about 2002 or 3, I used to compute this just for US stocks. Partly because the database I had access to, which was Value Line, had only US stocks in it. Then I'd land in Mumbai and I'd show this distribution of US stocks and I'd talk about how asymmetric PE ratios were. And some old analyst, usually in his 50s or 60s, would put up his hand saying, in India, it doesn't look like that. So what doesn't look like what? So distribution of PE ratios won't look like that. So how do you know? Gut feeling. And after about the 6th or 7th gut feeling, I got sick and tired of gut feelings and I said, hey, if I can get access to a global database, I'd like to do this globally. So for the last 15 years, I've been doing this graph, which takes all listed stocks around the world and computes a consolidated PE ratio across the world. So notice, I've like, if you look at current PE, trailing PE, forward PE, I've looked across all kinds of markets here, and they all share the same characteristic. You have the peak to the left, the tail to the right. And there are differences across markets. Clearly, some markets are, so this is a global distribution of PE ratios, and you see the same kind of distribution play out. And every single regional distribution looks exactly the same, peak to the left, tail to the right. Doesn't mean that all stocks have the same PE ratios, because you can see the median PE varies widely across regions. The most expensive market in the world at the start of 2018 was China, followed by India. The US was up there. And the cheapest market in the world was Eastern Europe and Russia, and at 10.02 times earnings. Already you can see the danger of just buying stocks based on low PEs, right? You're going to get a lot of East European and Russian stocks in your portfolio, and I'm not sure you want a portfolio of just East European and Russian stocks. And sometimes those differences can lead you to make judgments about an entire sector. I remember January 2013, computing price to book ratios around the world. And again, this is not tough to do. The data is in a big Excel spreadsheet. Now just compute the medians by region. Start of 2018, you can see that the outlier was clearly Japan. The median Japanese stock traded at 0.67 times book value. So we're going to make a regional bet. You might say, look, I'm going to buy Japanese stocks because collectively they look cheaper than the rest of the world. But the only way you see it is by actually looking at all of the data. So at the start of every year when I do my data updates, I do these for all markets. So I don't know why this particular packet doesn't have the 2019 update. I think the packet that you have, does it have the 2019 numbers or the 2018 numbers? The 2019, I must have opened the wrong packet when I did the presentation, because the numbers you should have in your packet should be 2019 numbers. Same kind of conclusion holds. And finally, I love using these graphs to take apart rules of thumb. I'll give you my least favorite rule of thumb. I remember being in an argument with a private, it wasn't even an argument, we were in the same panel, there was a private equity investor, and he said, we don't do this DCF stuff to pick stocks to invest in. And I remember asking him, how do you decide whether to buy a company? He said, we look at the EV to EBITDA, if it's less than 6, the company must be cheap. And I said, really? Why do you pick 6? He said, that's a time-honored number. It's less than, I'm convinced that some guy in Wall Street in the 1970s, probably got drunk in his office, came out of the office and said, from this day on, 6 times EBITDA is cheap, and it gets passed on generation after generation. And whenever I get somebody say 6 times EBITDA is cheap, I rise to the challenge. I give them a list of companies, because I have the whole list in front of me. For instance, in January 2010, if you told me 6 times EBITDA is cheap, half the market would have looked cheap to you. That's a very strange definition of cheap. Maybe in 2018, 6 times EBITDA would work for you, unless you happen to be in Russia. Do you see where I'm going? Why do we have these rules of thumb? If you really want to tell me something is cheap and you have all of the data, why don't you make it the 10th percentile or the 20th percentile? It'll be a number that changes across countries. It's a much more sensible way to think about what's cheap or expensive than putting up a number and say that number is cheap and this number is expensive. So if you're doing pricing, you're looking for ways to do it. I mean, absolute rules make no sense in a relative world. If I sound like Einstein in pricing, everything is relative. So you can't have 6 times EBITDA if half the companies in the market trade at 6 times EBITDA. That can't be a definition of cheap. So define, describe. Let's talk about analysis. Embedded in every multiple are all of the assumptions you're running away from in discounted cash flow valuation. We kind of said that at the start of the class, might have re-emphasized. So when you look at a multiple, there are 2 questions you try to answer. First is, what are the fundamentals that are embedded in this multiple? What are the variables that drive this multiple? And the second question is, as those variables change, how will my multiple change? Let's take each of those questions. Okay? To answer the first question, here's what I try to do. I go back to the simplest discounted cash flow model that I can think of. So if you give me an equity multiple, let's say price to book. For me to explain to you what drives the price to book, I'm going to go back to the simplest equity value. The simplest equity valuation model I can think of is a stable growth dividend discount model. It's called the Gordon growth model. So I take the stable growth dividend discount model, And then divide both sides of the equation by whatever your scaling variable. So if it's book value, I divide both sides by the book value. So on the left side now I have price to book. On the right side, when I divide dividends can be written as payout. I get the return on equity, the payout ratio, and the growth rate. The variables that drive the price to book ratio are basically the return on equity for your stock, the payout ratio for your stock, and the growth rate for your stock. With every equity multiple, I can go back to a dividend discount model. With the algebra, I say these are the 3 variables, these are the 4 variables that drive your multiple. If you have an enterprise value multiple, EV to EBITDA, EV to sales, I'm going to go back to the simplest enterprise value multiple equation I can think of. And remember, that's basically our next year's EBIT net of reinvestment divided by cost of capital minus the growth rate. You're saying why the simplest? You could use complex models, but your algebra will start to break down. It's just really how good. If you're really good at algebra, have a 10-stage model and solve it through. My algebra is not that powerful, so I keep it simple. Simplest, no. I divide both sides by, let's say, sales. If I want an EV to sales ratio, I can tell you the variables that drive EV to sales are the after-tax operating margin, the reinvestment rate, the cost of capital, and the growth rate. It's a very clean and clever way of backing out the variables that drive each multiple. You're saying, why should I care? I come to you with a stock with a low price to book ratio, and I say it's cheap. And I give you a chance to ask me 3 questions. What are the 3 questions you're going to ask me? What's its return on equity? Most of the time, what's the answer going to be? Horrifically bad. Right? How risky is it? Some of the times it's going to be really risky, high cost of equity. So what's its growth rate? Minus 5%. Most of the time, stocks that look cheap deserve to be cheap. This gives you a way of isolating those stocks where you get a mismatch. See what the mismatch is going to be? You want a stock with a low price to book ratio, high return equity, low risk, and a high growth rate. You say, what chance do I have finding something like that? No harm looking. That's the essence of pricing, is you're looking for mismatches, and this gives you a way of controlling for those differences. So let me take the PE ratio. Again, I'm going to go back to a dividend discount model. It's a stable growth dividend discount model. You do the algebra. Here's what I have as the equation for the PE ratio. It's a function of the payout ratio, the growth rate, and the cost of equity. If you don't trust companies to pay out what they can afford to in dividends, and I don't, you can replace the dividends with free cash or equity, which is potential dividends. You end up with an equation of the PE ratio as a function of your potential payout ratio using free cash or equity, your growth rate, your cost of equity. You've isolated the variables that drive PE ratio. And that is critical if you're going to use PE ratios as your comparison measure, because you now know what you need to control for when you look across companies. Differences in growth, difference in cost of equity, differences in payout ratio. Okay? So let's expand this, and this will be the last thing for today. That is for a mature dividend-paying stock. You're saying, but I want the PE ratio for Cisco or the PE ratio for Salesforce. This is not going to work. You're right. A stable growth dividend discount model is not going to work. But perhaps a 2-stage model will, where you have high growth for the first phase and low growth afterwards. Now, normally when you build 2-stage models on spreadsheets, you put 5 rows and 3 columns and do it. What the heck was that? No, I'm not doing that. No. But I'm going to actually take what you see on a spreadsheet and put it as an equation. Okay? Trust me, I'm not doing anything different. I'm just taking what you have in a spreadsheet and writing it as an equation. The value per share in a 2-stage model will be the expected dividends during the high growth phase. That's the first term in the equation. That's just a growing annuity equation applied to dividends, because then you can grow 30, 40, 50% a year, plus the present value of the terminal price, to the terminal value. That's what the second term is. So essentially I've taken what would have taken you 10 rows and 3 columns and put an equation. What am I trying to answer? As growth changes, how will the PE change, right? You remember high school calculus? You don't. But if you do, you see what your task is, right? If I ask you how will the PE change as the growth changes, what do you need to do? Take the first, don't worry, I'm not going to ask you to do this. You take the first differential of PE ratios to the growth rate. You can tell me how has growth, in fact, if you don't remember any calculus, go buy Mathematica at the bookstore. Put the equation in, it'll do first derivative, second derivative, third derivative. It's actually incredibly fun to do those and graph them out. It tells you absolutely nothing. You don't know whether you're climbing up a mountain or falling into a valley, but it's so great looking. But essentially, that's your task, is you're saying as growth changes, as risk changes, how will the PE change? So here's the final example, and then we'll end for today. So we have a stock. but the expected growth for the next 5 years is 25%, and it's going to drop to 8% in stable growth. Incredibly high, but it's a different time and a different environment. Payout ratio is 20% and 50% in stable growth. Beta is 1 in both periods. You have 5 years of high growth. So the risk-free rate is 6%. Cost of equity is 11.5. You ask me what PE ratio should the stock trade at given those fundamentals. Think of this as an intrinsic PE. You see why I'm calling it intrinsic? I'm not basing it on other companies. I'm just basing it. If I plug the numbers in the equation I just showed you, I come up with a PE ratio of 28.75. What does that mean? If the stock traded at its intrinsic value, it should trade at roughly 28.75 times earnings. Okay? Now any of these variables could change, right? If I change my growth rate, guess what happens? As I go from low growth to high growth, my PE ratio is going to go up. But I'm going to ask you a follow-up question. I'm 4 different columns. What are those? I actually graphed out 4 different risk-free rate scenarios from low to high risk-free rates. PE ratios increase under all 4 scenarios, but they seem to increase more under a low interest rate environment than a high interest rate environment as growth changes. Why is your PE ratio more sensitive to changes in your growth rate when interest rates are low than when interest rates are high? Yeah.
I guess you're assuming that you can keep borrowing money at a low rate.
You don't even have to go that far. What's the value of growth? It's all in the future, right? As interest rates rise, what happens to the value of growth? It decreases. Let's take this as an extreme scenario. Let's say you're in Venezuela and interest rates are 100,000%. What's the value of growth? Nothing. What if I surprise you and say you have more growth? It's still nothing. Nothing is still nothing. As interest rates rise to very high levels, growth surprises will have a smaller impact on PE ratios. How do these growth surprises manifest themselves in the market? Do you get a vision in the middle of the night where an angel shows up and says your growth rate is going to go from 25% to 15%? What form do growth surprises usually take? Usually an earnings announcement where a company says we used to grow at 22%, we're now growing at 2.2%. Sorry. You know what this graph says? The effect of earnings surprises in today's market will be greater than they were 10 years ago, 20 years ago. Why? Because T-bond rates are only 2.4%. We're in a low interest rate environment. Surprises about growth are going to translate into much bigger effects on PE ratios. So when you see stocks jump on earnings surprises, part of the reason for that is we're in a low interest rate environment. So when we come back on Wednesday, we're going to build on this thesis and use it to kind of look at different questions built around PE ratios. Yes.
So you said earlier that when PE ratio is obviously low for whatever reason compared to there's like a cheaper reason.
I'm saying most of the time.
Most people, but if most people are using multiple relative valuation approach, wouldn't that mean that
Nobody's powerful enough to move the market. There's no reason.
aren't all like say the sell side equity research people?
You can, but collectively sell-side equity research people don't move prices at all. They can affect price on any given day, but the effect they have on... Otherwise, all stocks with buy recommendation should always go up and sell recommendation should go down. That's not the case. You get that blip when they make a recommendation. Like today, somebody came out and said, G is overpriced and stock dropped 6%. Nevertheless, there's no basis for it. So collectively, investors can't wish up stocks or wish down because that momentum would never shift. So the market has a mind of its own. I mean, I remember Warren Buffett saying nobody's bigger than the market. And when it comes to pricing, you and I and everybody else in the market can agree on something, the market will go off in an entirely different direction.
And now also, so we were saying at the end, so under a low interest rate environment, so why does it have a bigger impact?
Because any change in growth, the value of growth is the present value of future growth. So when interest rates are low, that present value is going to be a much bigger chunk of your value. As interest rates rise, the value of growth is going to drop off because everybody wants cash today.
Oh, so this is Gordon growth model, the R minus G is R.
It's not even that. Think of this has to be a high growth version, right? So basically, if you have high growth in your company, that high growth has a value. Under low interest rates, growth is going to be a bigger portion of your value than under very high interest rates. So when I surprise you about growth, a much bigger chunk of your value is affected by it when interest rates are low and interest rates are high.
Why is a higher portion of your growth when interest rates are
Because the value of growth is the present value. So when interest rates are low, I'm giving your growth a much higher dollar value. Think of it purely from a cash flow perspective, right? I have growth, I take the present value of growth. When interest rates are low, the discount rate is low, so the value of growth tends to be much higher as a percent of your value. That's why I said think of the extreme scenario where interest rates hit 100,000%. Growth ceases to have value because any cash flow next year becomes worth nothing. So you either have the cash flows today or you don't. So the value of growth becomes close to zero. So surprising you by saying my growth is going to be higher, you say I don't care. So as interest rates get higher, you care less and less about growth.
Okay, got it. Thank you.